Three numbers, one asset. Completely contradictory answers. Silver is trading at $84.438 as of March 7th, 2026. Tech flow, that is today's number. The paper price, the number on your screen right now. CoinCodex algorithm predicts that the price of silver will decrease by 11.08% in the next 7 days and reach $74.61 on March 12th, 2026. Invest, that is the machine's answer. Pure technical analysis. Historical price patterns run through an algorithm. No supply deficit, no COMEX vault, no Iran war, no Fed, just the chart. And the chart says $74.61 by next Thursday. Bank of America's head of metals research, Michael Widmer, projects silver could reach anywhere between $135 and $309 per ounce before the end of 2026. Market pulse. That is Wall Street's answer from the head of metals research at one of the 3 largest financial institutions on the planet. Not $135 as a hope, as a base case, with $309 as the extreme scenario. $84 today. $74 says the algorithm next week. $135 to $309 says Bank of America by year end. These 3 numbers cannot all be right simultaneously. One of them is describing reality. 2 of them are describing something else. And your job right now, if you own silver or are thinking about owning silver, is to understand exactly what each of these numbers is measuring, exactly what each model is seeing that the others are ignoring, and exactly which framework actually maps to what is happening in the physical silver market today. I am not going to tell you Bank of America is definitely right. I am not going to tell you the algorithm is wrong. I am going to walk you through the inputs, the assumptions, and the blind spots of each model. Because the answer to who is right tells you everything about what kind of silver market we are actually in right now. Let's build it from the ground up. Every number I give you today is public and verifiable. Links to all data sources are in the description. Section 1. Understanding what each model actually measures, because they are not measuring the same thing. Before we compare 3 silver price forecasts, you need to understand what each one is actually built on. Because $74, $84, and $135 are not 3 different answers to the same question. They are 3 different answers to 3 completely different questions. The $84 paper price answers this question. What did the last leverage paper trade on COMEX settle at? That is all spot price measures. The most recent transaction in a market dominated by futures contracts, options, and derivatives. Open interest in silver futures is equivalent to roughly 240 million ounces, meaning paper claims exist for nearly 3 times the registered deliverable silver. Market pulse. The spot price reflects paper transactions on a market where 240 million ounces of paper claims sit against approximately 86 million ounces of registered physical metal. It is a real price. But it is the price of paper silver, not physical silver. The CoinCodex algorithm prediction of 74.61 answers this question. Based on historical price patterns and momentum indicators, where does the technical analysis suggest this price series goes next? Invest. The algorithm is not looking at COMEX vault levels. It is not reading the Silver Institute deficit reports. It is not tracking lease rates or Shanghai premiums. It is pattern matching. It is asking what has happened historically when silver was trading at this price level with this momentum profile. And the pattern it is finding says down 11% in 7 days. Bank of America's $135 to $309 answers this question. Based on the gold to silver ratio, structural supply deficits, and physical delivery dynamics, what is silver worth relative to gold at its current price? Market pulse. The ratio math starts with gold near $5,000. Apply the 2011 bull market ratio low of 32 to 1, and you get $135. Apply the 1980 Hunt Brothers extreme of 14 to 1, and you get $309. This model is not looking at last week's price action. It is looking at a century of monetary history, 3 questions, 3 answers, all internally consistent within their own frameworks. The question is, which framework is actually relevant to the silver market you are participating in right now? Section 2, the algorithm's case. Why $74 is not as absurd as it sounds. Let me give you the strongest version of the $74 argument first, because it deserves serious treatment and most people will dismiss it without understanding why it has analytical merit. The CoinCodex algorithm predicts silver will decrease by 11.08% in the next 7 days and reach $74.61 on March 12, 2026. The algorithm is based on the historical silver price movements, Invest. The algorithm is seeing something real. Silver hit an all-time high of $121.67 on January 29th. It then crashed to $75 by February 6th. That is a 38% collapse in 8 days. It recovered to approximately $91. Then the CME raised margins 36% and it crashed again to the low 80s. And today it sits at $84. The chart is showing a pattern of violent spikes, followed by violent crashes, followed by lower recovery highs. That is a deteriorating technical structure. and the algorithm is pattern matching that structure against historical precedents. The recent sell-off has come as a jolt and paints a more realistic picture, at least for the shorter term. The put-to-call premium ratio for the March contract stands at 0.92. What this essentially means is that even though more money is still in calls, the fact that the ratio is so close to 1.0 shows that the cost of protection is rising. The street options traders are paying nearly as much for downside protection as for upside exposure. That is not a bullish signal from the derivatives market. That is a market hedging aggressively against further downside. The silver price forecast for 2026 shows a wide range from $49.25 from TD Securities to an aggressive high of $309 from Bank of America. Citigroup anticipates levels around $70. HSBC projects a range of $58 to $88. CBS News. TD Securities at $49.25. Citigroup at $70. HSBC at $58 to $88. These are not anonymous internet predictions. These are major financial institutions with sophisticated research teams who are all projecting silver significantly below current levels for 2026 on average. They are seeing something the bull case ignores. What are they seeing? They are seeing a market that ran 148% in 1 year, from below $35 in early 2025 to 121.67 at the January peak. A market that ran that fast almost always has a mean reversion phase that lasts longer than the bulls expect. They are also seeing recession risk. A weak labor market combined with Iran war energy inflation is not historically a recipe for strong industrial demand. And silver needs industrial demand. 70% of silver consumption is industrial. A global slowdown cuts that demand meaningfully. The algorithm is not wrong about what it is seeing in the price data. The question is whether the price data is telling the full story. Section 3. Bank of America's case. Why 135 is the base case, not the fantasy. Now let me give you the strongest version of the $135 to $309 argument, and I want to be precise about something first. The 135 target is not the aggressive scenario. It is the base case, the conservative end of Widmer's range. The math behind both targets starts with the gold to silver ratio currently sitting at roughly 59 to 1. With gold near $5,000, applying the 2011 ratio low of 32 to 1 puts silver at 135s. Apply the 1980 extreme of 14 to 1 and the number climbs to 309. Market pulse. The 2011 ratio of 32 to 1. That is not a historical extreme. That is where the ratio was the last time silver had a meaningful bull market. It is the normal destination for this ratio during a precious metals cycle. To reach $135, silver does not need a Hunt Brothers squeeze. It does not need a COMEX default. It needs the ratio to do what it did in 2011, compress from its current level of approximately 59 to 1 back toward the level it reached the last time precious metals were in a structural bull market. The Silver Institute reported the silver market recorded its 5th consecutive year of structural deficit in 2025, with demand outstripping supply by roughly 95 million ounces. The cumulative shortfall since 2021 has now climbed above 820 million ounces, equal to an entire year of global mining output. A 6th deficit of around 67 million ounces is projected for 2026. Market pulse. 820 million ounces. Cumulative deficit. That is the equivalent of an entire year of global mine production. Gone, consumed, not coming back. That metal was used in solar panels, electric vehicles, AI servers, medical devices, and defense systems. It was not speculation, it was consumption. And you cannot replace consumed industrial metal by adjusting a futures contract. Mine supply has plateaued near 813 million ounces annually. New projects take 7 to 15 years to develop, and green energy mandates are locking in demand regardless of price. Market pulse 7 to 15 years to bring a new mine online. That means no supply response is possible within the time frame Bank of America is forecasting. Whatever new mine is going to address the 2026 deficit is currently somewhere between a geological survey and a construction permit. It is not producing silver yet, and it will not produce silver in 2026. Western physical investment is forecast to rise 20% to a 3-year high of 227 million ounces in 2026, as retail investors who missed the 2025 rally start moving in. Market Pulse retail investors who watched silver go from $35 to 120 wars in 2025 and did not buy are now sitting on cash watching a 30% pullback from the high. Every percentage point that silver falls from $121 is another group of buyers who decided to wait for a pullback getting their pullback. That is not a market that falls falls to $74 and stays there. That is a market that finds buyers at lower prices who were priced out at higher levels. The Bank of America model is not asking what the chart looks like. It is asking what the structural supply and demand reality looks like. And the structural reality is 820 million ounces of cumulative deficit, plateauing mine supply, rising industrial demand, and a ratio that historically compresses to 32-1 during precious metals bull markets. Section 4. The critical difference. What each model cannot see. Here is where the analysis gets genuinely useful, because both models have specific blind spots, and understanding those blind spots tells you when each model becomes most wrong. What the algorithm cannot see. London silver lease rates spiked to 34.9%, with intraday peaks of 39%, indicating extreme desperation for borrowable physical silver. Market pulse. The algorithm does not trade lease rates. It does not read physical inventory levels. It does not process the signal that 34.9% lease rates send about the state of physical silver availability. Normal lease rates are 0.3 to 0.5%. Current lease rates are 34.9%. That is a 70-fold increase from normal. The algorithm processes price history. It does not process the physical market stress indicator that says the premium for immediately available physical silver is 70 times normal. What the algorithm also cannot see. COMEX open interest is equivalent to roughly 240 million ounces, meaning paper claims exist for nearly 3 times the registered deliverable silver. The coverage ratio of registered metal divided by open interest ounces sits near 0.4. Market pulse. An algorithm that pattern matches historical silver price behavior is pattern matching against a history where the coverage ratio was never 0.14. It is finding a pattern that does not account for a market that is structurally unlike any historical precedent in its data set. What Bank of America's model cannot see. Timing. The ratio compression argument is structurally sound. The supply deficit argument is structurally sound. But neither argument tells you when the compression happens. Ratios can stay elevated for extended periods. Supply deficits can persist without immediately forcing prices higher if paper markets absorb the visible demand. Bank of America's $135 target could be right for 2026, and silver could still trade at $74 next week. Both things can be simultaneously true. The put-to-call premium ratio for the March contract stands at 0.92. What this essentially means is that even though more money is still in calls, the fact that the ratio is so close to 1.0 shows that the cost of protection is rising. The street. The options market is telling you that short-term traders are aggressively hedging downside. That is consistent with the algorithm's $74 target for next week. It is also consistent with Bank of America's $135 target for year-end. The two are not mutually exclusive. Silver could absolutely test $74 next week and still end 2026 at $135. A 76% move from $74 to $135 in 9 months is well within silver's demonstrated range. The metal moved 148% in 12 months in 2025. Section 5. The 5 other forecasters. Where the rest of Wall Street stands, let me add the full institutional picture because the $84 versus $74 versus $135 framing leaves out 7 other major institutions who all have public positions on silver for 2026. For 2026, the average estimate spans a wide range from $49.25 from TD Securities to an aggressive high of $309 from Bank of America. Citigroup anticipates levels around $70. HSBC projects a range of $58 to $88. BMO Capital maintains a steady stance at $55. CME Silver Futures positions the year-end average near 91.23. CBS News, let me array these clearly, on the bearish end. TD Securities at $49.25. BMO Capital at $55. Citigroup at $70. These are institutions projecting silver significantly below current levels for full year 2026 average. They are not predicting a crash. They are predicting that silver's current $84 level is above fair value on an annual average basis given their economic models. In the middle, HSBC at $58 to $88, CME futures at 91.23 for year-end average. These projections bracket the current $84 price. They are saying silver is approximately fairly valued right now, or has modest upside. On the bullish end, Citi at $150 within 3 months. Note, this is a different Citi forecast from a different analyst than the $70 annual average, demonstrating how much internal disagreement exists even within a single institution. Bank of America at $135 to $309 by year end. The CoinCodex end-of-year prediction of 210.39 for silver by year-end 2026 represents a 150.73% increase from current levels. Invest, the same algorithm that says 74.61 next week, says 210.39 by year-end. That is the internal contradiction inside algorithmic forecasting. Short-term momentum is bearish. Long-term structural pattern is strongly bullish. The algorithm is seeing a sharp short-term correction followed by a significant long-term recovery. That is not inconsistent with Bank of America's 135 scenario. It is actually telling the same story on different timeframes. Section 6. The physical market data that most models are missing. Here's the layer underneath all of these forecasts that the models with the most sophisticated data inputs are picking up, and the ones relying only on price history are missing entirely. COMEX registered inventories have plummeted over 70% since 2020. Industrial demand keeps accelerating. Solar panels, EVs, and AI hardware are consuming record amounts of silver. Mine production grows at just 1 to 2% annually. Market Pulse 70% registered inventory decline since 2020. That is not a price chart signal. That is a physical supply signal. The vault that backs the paper market has lost 70% of its deliverable metal over 5 years, while paper claims against that vault have not declined proportionally. That structural mismatch does not show up in a price algorithm that is looking at historical price series. It shows up in delivery reports, lease rate data, and the Shanghai premium. The $135 base case assumes a natural bull market continuation without a squeeze or panic buying. The 309 target is a different animal. It would need a liquidity event, a delivery squeeze, or a surge in physical demand that overwhelms paper markets. Market Pulse Widmer himself is saying that the base case does not require a squeeze. It requires natural continuation. The vault is down 70%. The deficit is in year 6. Mine supply cannot respond for 7 to 15 years. Industrial demand from solar, EV, and AI is structurally growing. Those 4 facts alone, without any squeeze, without any panic, without any COMEX drama, produce the ratio compression that gets you to 135. The squeeze scenario, the vault at 0.14 coverage ratio, the 34.9% lease rates, those are potential accelerants to the 309er end of the range. They are not required for the $135 base case. Section 7. The bear case for every bullish model, because honest analysis requires it. I always give you both sides, so here's the strongest argument against every bullish silver forecast, including Bank of America's. A recession would cut industrial demand sharply and remove the green energy tailwind. Macro headwinds, recession odds, and dollar strength remain the biggest threats to any commodity rally in the second half of 2026. Market Pulse. The February NFP just printed minus 92,000 jobs. December was revised to minus 17,000 jobs. 3 negative payroll months in 5. That is not a soft landing. That is a labor market cracking, and a cracking labor market leads to a slowdown in manufacturing, construction, and industrial production. When industrial production slows, silver demand from electronics, solar, and construction slows with it. The silver futures contract for March 2026 is up more than 25% on a year-to-date basis. Even after the sell-off, silver remains significantly above where it started 2026. The Street. Silver is still up 25% year-to-date, even after the 30% correction from the January high. The mean reversion from a 148% 2025 move and a 25% 2026 move so far is not complete by historical standards. Corrections from parabolic moves of this magnitude typically run longer and deeper than bulls expect. Paper market caps. Short sellers and bullion banks can suppress spot prices for extended periods. Physical delivery squeezes are possible but not guaranteed on any timeline. Market Pulse Bank of America itself acknowledges that the paper market can suppress prices for extended periods. The physical bull case can be structurally correct, and the paper price can still trade lower for 6 to 12 months before the physical reality forces a repricing. Being right on the structural argument and wrong on the timing is a real way to lose money in any market. The bear case is not that the physical silver story is wrong. The bear case is that the paper market has more tools and more time than the bulls expect before the physical story forces a repricing. The algorithm is modeling that extended suppression. Bank of America is modeling the eventual repricing. Both can be simultaneously correct on different time frames. Section 8. How to use all 3 forecasts together. The framework that actually helps you. Here is the practical synthesis that makes all 3 numbers useful simultaneously rather than forcing you to pick one. Use the algorithm for short-term risk management. The CoinCodex algorithm predicts $74.61 by March 12, 2026. Invest. Whether that specific number is right or wrong, the algorithm is telling you that short-term technical momentum is bearish. That is useful information for position sizing. If you are holding leveraged silver positions, the algorithm is warning you about near-term downside risk. If you are an unleveraged physical holder, the algorithm's $74 prediction is your potential near-term buying opportunity signal, not a reason to sell, a reason to have dry powder ready. Use Bank of America for strategic positioning. Widmer frames his targets as scenarios, not certainties. The $135 base case requires natural bull market continuation. The 309 extreme requires a physical delivery squeeze. Market pulse. The structural analysis behind these targets does not change based on whether silver trades at $74 next week or $84 today. The supply deficit, the vault drain, the ratio math, those are multi-month to multi-year forces. Bank of America's model is telling you where to position on a 6 to 12-month horizon, not where to trade next Thursday. Use the current $84 spot price for one specific thing. Comparison against the physical premium. If silver is trading at $84 on paper, but physical dealers are quoting $87 to $90 for immediate delivery, that spread is telling you the algorithm is wrong about the direction of the physical market, even if it is right about the direction of the paper market. Watch the dealer premium on physical silver alongside the spot price. When premiums widen while spot falls, the physical market is rejecting the paper price signal. Silver is trading at $84.438 as of March 7th, 2026. The 52-week range and trading volume are key indicators to watch. The weekly Exagus D chart shows a bullish trend. Tech flow. The weekly chart bullish while the daily chart is under pressure. That is the time frame conflict that makes all three forecasts simultaneously defensible. The algorithm is reading the daily and weekly momentum correctly. Bank of America is reading the monthly and annual structural picture correctly, and the spot price is reading the last paper transaction correctly. None of them are lying. They are looking at the same asset through completely different lenses. Section 9. The honest conclusion. Here is the full picture as of this morning, March 7th, 2026. Silver trading at $84.438. TechFlow CoinCodex algorithm predicts $74.61 by March 12th, 2026. An 11.08% decline in 7 days based on historical price pattern analysis. The same algorithm projects $210.39 by year-end 2026. A Invest. Bank of America head of metals research Michael Widmer projects $135 to $309 by year-end 2026. The $135 base case uses the 2011 ratio low of 32 to 1 against $5,000 gold. The $309 extreme uses the 1980 Hunt Brothers ratio low of 14 to 1. Widmer frames these as scenarios, not certainties. Market Pulse full institutional range for 2026, TD Securities $49.25, BMO Capital $55, Citigroup $70, HSBC $58 to $88, CME Futures year-end $91.23, Bank of America $135 to $309. CBS News, Silver Institute's sixth consecutive deficit year projected for 2026. Cumulative deficit since 2021 exceeds 820 million ounces. Mine supply plateaued at 813 million ounces annually. New projects take 7 to 15 years to develop. Market Pulse COMEX coverage ratio at 0.14. Registered inventory down 70% since 2020. London silver lease rates at 34.9% versus historical normal of 0.3 to 0.5%. Market Pulse. Who is right? The honest answer is that the algorithm is most likely right about next week. Bank of America is most likely right about this year, and the $84 spot price is accurately measuring where paper silver traded in the last transaction on a market where paper claims outnumber physical metal by 7 to 1. All three numbers are correct about what they are measuring. None of them are measuring the same thing. And understanding that distinction is the most important analytical insight you can carry into whatever decision you make next about silver. The algorithm trades charts. Bank of America trades structure. Physical buyers trade reality. Which one you listen to depends entirely on your time frame, your leverage, and whether you are holding a paper contract or a physical bar. Invest with logic, not hype. Protect your capital. The chart tells you price, the data tells you direction, and the structure tells you destination. Drop your number in the comments, $74, $84, $135, or $309. Which forecast do you think is closest to where silver actually goes from here?